If we just think about single family rentals, like someone starting off, like usually you're going to go and buy a single family rental.
Right.
Like that's what you're going to do first. And in San Diego, the median home price is, I don't know, $1 million. So you need to rent that for $10,000 a month. There's just no deals that do that. But you can go, like you're saying, markets. Maybe you go to Knoxville or some of these up and coming markets and you could find those good deals because they haven't seen that torrid price appreciation on the homes.
Yeah, the cap rates are still relatively simple and normal, and you can still make a spread above what debt's costing you.
Yep.
So another rule of thumb is 2% from your cap rate to your interest rate. So if you're buying a 6 cap, you want to borrow money at 4.
Yeah.
If you're borrowing money like today, it's 5.5. Let's say 6 to 6.5 on a normal multifamily deal, or even what's a home loan? 6.5, 7 right now. So then you'd want to buy an 8 or 9 cap. So that's where the tough piece comes in. So then what you're hunting for is not, there's a lot of push to go into like zero down and find like these ways to cleverly step into homes that have loans where they just got displaced or they took another job and they need to leave and they're upside down in their house. And like, I love the Pace Morbies of the world because they do a huge value service to people, training, going out there and shaking bushes for deals. And I agree that if you get into that, you should just go focus on it. But I've found in multifamily that to be a pretty challenging unicorn quest where you might end up in some Timbuktu town. It's hard to find those deals in big metropolitan locations are very rare. So what Pace Morby did was he built a deal generating machine, a deal mining machine to find those little unicorn deals all over. And he finds ways to step in super low down, but then Pace Morby also raises a bunch of money.
Yep.
So there's ways to do it, but I would say you're better off to focus in major metros, pick your top 5, then pick your top 1 or 2, go super deep and know and understand the underwriting. And then you'll find that, okay, now I know this market so well that I know that this mom and pop are $200 under the rent.
Right.
And you get closer to that 1%. Let's say in Phoenix, if you buy some older apartment for $100,000 a unit and you can get $1,000 a month, but maybe they're at $750 right now. And so there's a value proposition. Just right now you can raise the rents there or by going in and doing a little bit of a cleanup. And so that's what we find all the time in mobile home parks.
Yeah. And so that's our sweet spot.
And that 2% rule that you're talking about, like we all talk about this all the time. I love deals where if you go in, let's just say that the debt for commercial property right now is probably with Fannie or Freddie, I don't know, 5.5, right? 5.5%. But if you go in at say like a 5 cap, right? And that's what you're buying. So you're negatively levered on the deal. But if you're saying in that example, you're under rented and you know that you're not making a guess on where rent growth is going to be, but you're getting
this isn't projection.
Yeah,
this is like the market comps today. And the current rents are way below.
Yeah.
And then, and so you could say, okay, if I make this assumption that in the market, things are about 95% occupied, I'm looking at all these comps that are similar quality and these are where the rents are. Then you do a calculation to market cap, meaning you then just you keep your expenses, maybe elevate them a little bit, but then take your revenue, your new rents at that occupancy. And then if you get that spread over that debt, right? So say if you're at 5.5 all in, if you mark to market at a 7.5 cap in year 2 or 3, that's a great deal.
It is.
All day long.
Yep.
And so it's a little bit of pain on the upfront. You're probably not going to cash flow really much. But if you could say, look, I'm buying a great deal today that I know with some certainty that is going to perform and be at a 7.5%, cap rate. That's a deal I'll do all day long. And most sophisticated real estate investors will do all day long as well.
Yeah. And then you're working. So then that leads into financing strategies, which is another question. Question about funding are huge. People ask about leveraging mortgages, using creative financing like seller financing or hard money loans, or even tapping into home equity. They're keen to understand how to minimize upfront costs while maximizing returns. So I love seller carry. I'd say actually right now is a great time to just send those offers. Just send them.
Because you just don't know what the receiving person is going to say. I mean, it might be a great deal. It might be a tax play for them. You just never know right now, especially.
The big discrepancy between what sellers really want and feel that their property's worth versus what buyers are willing to pay if you take a standard loan product. So if you can make an offer that works for you, make it initially that really works good, even lean a little heavy on your ask on a super low down payment and a super cheap rate. We're looking at a deal right now where we might get the deal done with 25% down, 3% interest only for 5 years. And then it starts to step up through years 10. So we make the offer. And then if it comes together, it's a great deal. It gives us the opportunity. It cash flows well day one. So that's where just continue to be in the market and then make offers with what works.
Yep.
And like another strategy that we're doing for the listeners that if they wanted to do this as well is make multiple different offers. So we'll send 3 different offers with different terms, different purchase price.
A, B, C.
Yeah. Get creative because you never know what's gonna be a driver. Usually sellers aren't gonna tell you everything. And so you just lay it all out for them and then they could weigh it and then come to you with some questions, or maybe it's the purchase price that they're really hung up on. Maybe they don't want to do seller care. They just want to get rid of it. They're willing to take a smaller purchase price or whatever it is. But you should always like try to be as creative as possible.
So that you can figure out what their motivator is to get that information. So you make them the best offer that they want.
I also think with unsolicited offers too, a lot of times when we're dealing with mom and pops, they're not as engaged with the market. So they don't necessarily know where they're actually standing in that moment. And by explaining through a few different options, they're kind of seeing the full picture where they're not offended by a one-off ask that is using real terms because they've been told for the last 3 years their property's worth more money from all these brokers.
Right.
Now they're seeing, oh, I see how they're calculating and what they're looking at from a debt standpoint. And it's more of an upfront thing. It's like building a relationship out the gate, I feel like.
Yeah, we did that a few months ago. We sent an offer. I'm just going to use different numbers just to make sure nobody can catch what deal I'm talking about. But we sent a $50 million offer, seller carry, 3% interest only for a period.
Yeah.
We sent option B as we just did 2 because we were actually trying to paint the picture of, guys, your deal is only worth $40 million. So we sent $50 million with a 3% IO carry, seller carry for 5 years. And then it stepped up from years 5 through 10. And then a $40 million, $10 million less at current rates because it needed a ton of equity in order to get a 6%, 5.5% loan today, where the rents were today and the income and the performance of that asset today. It was a $10 million swing.
Yeah.
And then we could have them carry more. So the loan to value is significantly more on a seller carry in that pitch, to where our equity was reduced so we could lean in and pay $10 million more, knowing where we could get rents. And that one was a funny, crazy swing. But what it did was it shoved them off the edge of their decision and they ended up selling it for $42 million.
And that's just such a good point. Like when you bring that up, someone's like, that doesn't make any sense. Why would you pay 50 million when it's really worth 40 million? They're 40 million and they're just giving you like a seller carry deal, but it's the time value of money. And that's how debt impacts asset prices, whether it's real estate or stocks or whatever it is, bonds, especially obviously. But that's why people need to understand that when interest rates go up, all else being equal, valuation should go down.
Yes.
At the end of the day, it's all about structure. And we've heard some mind-blowing deals that were extremely expensive, but because of their structure, they were able to get like a 10 IRR on these cherry Class A assets. And that would normally not yield a 10 IRR. You know, that's a big threshold for Class A, perfectly located product.
Yep.
Yeah.
So I guess just quickly to kind of add to that, just to get your guys' opinion, if someone was going to ask like, what, in your opinion, is the best structure for a deal?
Yeah. Give us a hypothetical person who's asking the question.
Yeah. Somebody who's willing to raise private money, but then also wants some debt. But what's the ratio that you would really kind of like, is there a happy medium to get the best return or just depends on market? Just to be coming from a
Well, so you're asking from somebody that wants to put and structure deals, raise equity and buy real estate deals and become a sponsor long term.
Yeah.
And then it's really about your ability to assess risk and your pain tolerance and how much risk you're willing to take and how much money of other people's you're willing to lose. And that's what it boils down to. Like,
yeah, I would agree with that.
And so I would never give somebody advice to go take super high debt We never did. We obviously have had loan to values float up and down over the years. We took 3 floaters that ended up a complete disaster. We ended up getting out of them, but they were no fun. And so we got super lucky, and I'd say even blessed, to have the rent growth and the top line gross revenue increase to where we could get our net operating income up to refinance out of those when interest rates ran on us like crazy.
Yeah.
And those deals started at 2.3% interest deals, and they ran up to like 7.
Yeah.
Which
the 2.3 is really desirable. And like
the deals, if they were to stay there, they'd be singing.
They would. But to your point, it's like that risk level, right? It's, are you worth risking the 2.3 rate going to 7 and totally blowing your numbers and your pro forma? Or do you just settle in the middle and have the certainty of that to then build? And so I don't know, there's so many ways you can structure
our
deals.
recommendation would be to take as the best rate. You could take max leverage that is real, that's not bridge debt, that's not based on a pro forma. Take real fixed rate debt that's based on income today, or what it's going to be through your closing, real actuals for the last trailing 3 or 12 months.
Yeah. And really try to leverage.
And just focus on getting a good fixed rate and doing your job to minimize the cost of the debt.
And raise the additional cash to bridge the gap.
All right. If you're enjoying this content, hit the subscribe button and turn on notifications, and check out the description below for our websites listed. Thanks a lot for joining.